All right, so we had a perfect week this week, about as perfect of a bullish week as you can possibly get. I'm going to tell you why, what signs we saw that suggest that, and what signs we saw that suggest that this may be one of the most extreme bullish markets that we've seen in some time, and what the precedent has been in the past for similarly extremely bullish markets. And what we can expect to see going forward, and what our margin of safety might be, especially in some of these hotter areas, and in particular the NASDAQ 100. So I'm going to break all that down. I'm also going to break down a nice little pattern that we're seeing in yields, and how that can impact expectations going forward from here, which will also influence our trade idea of the day. So let's go ahead and get started. Today is Friday, August 28, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. As we finished this week, great week to the upside. Every day of the week was a new all-time high. So after not getting a high tag over here for a long time, we got one every day this week. In fact, we actually, too, not only that doesn't get a whole lot of discussion, but we also gapped up every day this week. So, I mean, that was about as perfect of a bullish week as you could possibly have, finishing at new all-time highs every day of the week with an opening gap. And it's, the first day, captured most of the gains. The gap captured most of the gains, but, and then you can see the rest of the week, not so much. Like Wednesday's gains was mostly during this session, and you can see today's gains was, well, about half of it was during the session. And then yesterday's gains, you can see, in fact, all of it came overnight, and most of it here as well on Tuesday. But regardless, opening gains to the upside, opening gaps to the upside, and all-time highs every day of the week. And we'll talk more about those gaps here in just a minute. Let's break the Market Forecast Indicator down. As you can see, I mean, the intermediate posture is at really high levels. Really has been for quite a while. Very similar to kind of this period here. That also had a couple of clusters in it that produced a light pink shading. Nothing more than that. We are significantly up above that 30-day moving average. When I pull up this PPO indicator here, and look at the 30 and then one right here on the simple moving average, you can see, we are about 5% up above, almost 5% up above. And we've been higher, obviously, during this June 8th peak. We went up higher, but it's usually, it's not very much higher. As you can see, all during this period, we never got 4% or 5% up above. If I go back, 5 years, just to kind of give you an idea here, 4.78. Let me just draw a line here at 4.78. And you can see, okay, well, that in January of 2018 we got that high, and that's about the closest that we got, outside of this April peak when we really blew through the moving average and started the trend. Had a couple 23% retracements there afterwards, and then the June 8th, which also produced a couple 23% retracement moves afterwards. The difference this time, these two 23% retracements did not produce even light pink shading. This one didn't get below the moving average, but did produce light pink shading with a yellow line. The next one's actually going to produce might not produce a red line per se yet, but we will be significantly below the moving average by the next time we produce a 23% retracement. And we're looking at more than close to a 10% loss if and when we do pull again back down to that level. Because we will. We always do, right? The intermediate line, there's always an intermediate pullback. And the longer we go, the bigger they are, simply by virtue of the length of the trend produces bigger pullbacks. That's just the nature of the beast. But this is a pretty decent move here, 4.78%. It's higher than any of these other periods. So a little bit of a kind of a, is this quite the run that we've had Is this the point where we slow down? Are we going to pop up again? See, this one was fueled by a catch-up trade in the Russell. This is not fueled by a catch-up trade in the Russell. This is fueled by what initially fueled this one. That got, where the Qs just really brought us up off these lows and started the trend, right? But like I said, both of these periods produced 23% retracements, and neither one of these were trend changing, even intermediate trend changing. Whereas this one, the next 23% retracement will be intermediate trend retracing. So it depends upon when it starts and how it starts. Because if we start slowing down the movement, then the 30-day moving average will catch up, bringing this line down here, but also will pull it even further away from the 23% retracement level. And as I also always remind market scholars, a drop between 0 and 23% is pure noise. So there's no supports, significant supports that can hold us, that can keep us from dropping to those levels. So, and that's like outside of the 4-week range now, as if we were to get down to that point. So that just kind of gives you an idea, of how quick and how sudden that kind of move can be. I mean, again, you look at over here when we really took off, in 3 days we were down to 23% retracement. 3+ days, kind of a little bit slightly lower lows on these 2 days afterwards. But as always, has been the case lately, the Russell 2000 is just not participating. It actually came close to a cluster here, with everything kind of turning up and actually getting more of a bullish candles we've seen in a while with that gap and closing above some lows here, but just not participating to the same extent. And for that matter, the NASDAQ really didn't participate a whole lot either today as well. It got a higher close, but didn't get up to a higher high. In fact, today's range, which was much smaller than yesterday's range, which was an above average range, and today's was was about half of the average. So much smaller range, complete inside day coming in here. So we'll see how that impacts things going into next week, especially with how the VIX has been behaving this week. One more thing I wanted to notice, the NASDAQ, or the Dow Jones, interestingly enough, because it has had composition changes, it's getting a lot closer to that 100% level and pulling away from the 78 a lot more than the Russell is. So the Russell's still kind of hovering around the 78% retracement and unable to get going to the 100. The Dow had been behaving similarly until the news of the composition changes came about. And you can see how that's impacted the blue chip index and brings it up and to more of a catch-up situation to where the S&P is. So again, right about here is where the Dow is versus down here is where the Russell 2000 is on a relative basis. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us that you liked our video, and that tells us that you want us to do another video again on Mondays. So if you like our videos and you want us to keep doing them and you want to let us know, you can do it with one click right now while you're watching. Of course, if you don't like our videos, you don't have to click on anything. Also, comment down in the comment section below. What did you get out of our video today? What questions or comments do you have? Post all those down below, and let's keep this conversation going. Join our website at marketscholars.com. There's a link popping out right there at the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up there, DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out our classes over here on the right, as well as our archives. If you want to see all of our archives, we record all of our trading rooms, so anybody, even new subscribers, can get access to all of the classes we produce now for almost 3 years. You get all those here when you click on trading rooms. You also get access, even our monthly subscribers get access to our Market Outlook Live, where I go back and I review old trade ideas we do in these videos. I do those every day. I do the Market Outlook, so Monday, Wednesdays, and Fridays. Those are at 3:30 Eastern Time. Click on this link here. That will take you. It's also listed right here underneath Market Outlook, under Market Outlook Live Trade Review. come down here and click on this heart. That opens up this new window, and we invite you to like today's market outlook tweet. Eventually it will come up here. Hit that like button right there. Same thing here. Hit that thumbs up icon. It opens up a new tab with your Facebook. On Facebook, where we invite you also to like today's market outlook Facebook post. Eventually it will come up. Apparently my internet's acting a little slow right now. But hit that like button right there. Again, the more you like the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers, even those that weren't on their phones or computers when these posts got posted. But it also benefits you because these platforms will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, let's get back to the charts and let's see how the weekly chart ended up. And man, look at that candle. I mean, that's about as big of a candle. This is not a log scale. Now, again, using log scale charts versus arithmetic charts is like one of the worst chart crimes you can commit. This is not. It looks like it's a arithmetic scale, but it's actually log. So you can tell over here by the numbers. And that kind of just shows, again, I mean, look at that big breakout candle there. Big, strong week that we've had. Again, the PPO now for the week, the PPO of the 10 and 40 week moving averages, which is our proxies for the 10 and the 40, and you can see we are pretty close to January 2018 levels when we were that bullish. Coming off of here. So very, very significant move. Again, going out even further, so you can see, I mean, there's been other times that we've been this bullish. They didn't lead to necessarily significant pullbacks or even all the way down to the 200-day moving average on either of these periods. We still continue to grind higher. And, similarity between now and 13 is we are in a QE environment, an indefinite QE environment. Now, granted, the balance sheet's not growing indefinitely. They've said that they can, but they haven't been. Let's see here. If I were to look at there's the balance sheet, and you can see if I look at the rate of change, this is QE. This is indefinite QE, right? That's where you have. Let me bring up rate of change here. That's where you have an indefinite purchases, and that's what a lot of people think we are in right now. And because that's what they've said, that they can do that, but they haven't been doing that, right? They had one big jump higher. Here, sorry, let me change those colors so they're a little easier to see. We had one big jump higher in the rate of change, and you can see now, see over here in 2013 how it was gradual, like we got up, it stayed, it was growing at about a 5% clip on a 3-month basis, rolling 3-month window, until we finally started to taper at the beginning of 2014 is when they announced that they would start, at least when they started to taper, and then they finished adding to the balance sheet at the end of 14, and you can see we essentially went negative after that. And that's about where we peaked, and we didn't go any further from there, even though we were still going higher with this falling rate of change as we were tapering. Well, again, in 15 and 16, not a whole lot of change to the balance sheet. Even in a really good year, 2017, there wasn't a whole lot of change. But again, in 2018, there's a lot of chatter. I've talked to you multiple times about this idea of a stealth bear market starting in 2018. Well, you can see, look at the Fed's balance sheet did in 2018 and all the way through the fall of 19. And where we kind of talked about the idea that's kind of where it ended, right? And except for this COVID low point that we had. Well, there's the COVID low, and boom, now you notice in a 3-month rolling window that we are not growing the balance sheet anymore. We're already back down to actually decreasing the balance sheet. Now, we're not breaking the 50-day moving average, kind of like how we did over here, where we were flirting with the 50-day moving average, and then finally the 50-day cross, and we really had a decrease in the balance sheet. So we don't have that, right? But we're not growing it anymore either, and so it's a little bit of a misperception there as well as, again, you can see that the jump that we had here, not nearly as big as the jump that we had, both on a rate of change as well as the PPO, and you can even see just the size. But a significant jump, but not a program of purchases like you saw with QE2, and to an even bigger extent QE3, all the way through the time, through its tapering and then ending at the end of 2014. The dollar really took off from that period, and then right about here is where the dollar started to make a downward move after this QE3 ended. But you go back to the chart itself, the S&P, and you see, again, how strongly bullish, so kind of a breakout on the Hakinyashi here. This is the breaking out above the 100, this old COVID high point. You look at the NDX and you see a similar pattern. There we go, the NDX, very, very bullish, has been very, very bullish for a while, breaking through the 162% extension of this reversal that we've had. So remember, the S&P is just barely getting up above. The S&P is right here, just barely getting above the 100% level, maybe at the 38%. The Russell 2000 and the Dow are right around this. The Dow's a little bit above it, the Russell's a little bit below it, but right around this 50% of the move that the Nasdaq has made. So that kind of shows you how much those other indexes are lagging and how much room this has to make a catch-up trade to the downside. And it wouldn't be trend changing. I mean, look how wide the gap is between 0 and 38%. You're talking nearly a 20% drop just to get down to, say, this old 100% line, where all the other indexes pretty much are currently right now. So big move on the Russell 2000. Again, hasn't been participating to the same extent, and you can see second week in a row of an inside week on the Russell 2000 as Hakinyashi. It's going to end up opening right around 1558. We're trading at 1578. So just a little bit of a sign that things might be petering out here from a broader standpoint, broader than just the big tech names that have been so big, momentum names that have been just driving things higher this week. All right, so when you look at the 3 green arrow chart, you can see the 3 green arrows persist, and as I said before, until you break the 8-day moving average, there's just nothing to even consider about how the strength of the trend. But we are, again, pretty far, as I showed you, pretty far up above that 30-day moving average. So keep that in mind in terms of the strength of this move that we have right now. You look at some of the other oscillators like the RSI. I mean, it's close to 80. Like, in fact, what did we get to today? 79.25. And again, I mean, we have some precedent for some pretty significant moves on the RSI in the past. 2018 being the big one, and it actually got up to above 80. In early 2017, we got up to slightly above 80 as well, and you can kind of see the move we had there versus the move we had here. Now, we didn't have nearly the same intermediate run in 2017, but still, that was, we had, this intermediate rally occurred coming off of the November election low point. We finished this big long rally with a big RSI. We finished this long intermediate rally with a big RSI. Are we finishing this big long intermediate rally with a big RSI? And that's just on the SPX. If you look at the NDX, you can kind of see, that it's, it's not anywhere close to the 80. So, we might have another week or two left of kind of blow off top moves similar to what we've seen before, or this might be it, right? You'll see we actually diverged here pre-COVID before we finally had a little bit of a pullback there. Of course, the Russell 2000 not anywhere close, right? At least it's above 60, and it hasn't dropped below 40 and stayed there, so it's still pretty bullish, obviously, on this bullish trend, but not nearly as bullish as what we even see on the S&P. And of course, the DMI, I mean, look at the ADX now. It's all the way up to 40 on the S&P. We've seen this before over here, and then we got a divergent high point there, and then we saw it, we saw it again. Let me go back and give you some perspective on other times where it's gone positive with an ADX over here in 2018. It got all the way up above 50. It got up to about 50. Was it? Yeah, right about 50 on the ADX 52. It looks like almost 53 before things finally rolled over there and going into that 5th month. And remember, we're still about a week or two away from the 5th month that we have going on right now. So, and you can see how strong the positive index got there, how weak the negative index got over here. Pre-COVID, we saw, relatively strong, but not nearly to the same extent, and the negative index got below 10. Well, guess what? Our negative index is back below 10 again. And when it's below 10, it hasn't stayed below 10 for very long. It didn't stay below 10 there before we diverged with a high point. Over here in 18, what was it, 2018, sorry, it's right here, it spent about a week below 10 before we really started to ramp up. And over here is another period of time in early 2017, as I showed you before. Again, didn't stay below 10 for very long. We've already been below 10 here for a few days, 1, 2, 3 days. So keep that in mind in terms of how long, how much longer we can maintain the strength of this trend, which, as you can see from an Ichimoku cloud perspective, is still very high. Again, not as high as we've seen. That January 2018 remains still a very, very high level. It's about as high as the trend quality got, but still pretty darn high. All right, now let's take a look at the intraday range today, and you can see the move that it's had, and again, without that low changing, it's going to change on Monday, significantly change, right? It's going to go up about about 6 points, 8 points, but as of right now, that's a 29 point. We're talking nearly 10%, which is typical when you're coming up off of a significant low. But when we are, already at a pretty mature intermediate run, that's a really, really big number, because usually it's the 5% mark that we're looking for to kind of show that the rubber bands are stretched. So now consider how much more stretched they are. Now they'll come back, and like I said, for a few days the low point will be there, and by the end of the week, the low point will be up into probably about 1, 2, 3, 4, 5, up into this area, so 332. So now we'll be back to about an 18-point range, so about 5% at that point. So the rubber bands will still, but that will still be a pretty stretched level. It won't be as stretched, assuming that if we don't get any new highs next week, we'll be back to that level. But if we keep going up at the same pace, it's going to be hard for the lows to kind of keep pace with that move. And again, you can see, there's this very, very little, like when we talk about risk reward and margin of safety, your risk on this chart, like we can fall with all these gaps that we've had this week, we can fall down to 338 without skipping a beat. 340, 339, 338. We can fall down to that level, and it would be nothing. It would just be a noisy move because of the lack of volume support that we have. So that doesn't mean we will. It just means that that's what our risk is, right? So for, we think about how bullish we want to be, an 11-point move, even coming over here, is a different story. We were a lot closer, but as you pull away from where that support is, then, you don't have nearly the same level of support anymore. And very easy to fall, which means you got to have some pretty decent opportunity to the upside to justify such a large amount of risk that you have from current levels. Again, you look at today's volume and trading range, and you can see 48 million, not that big of a deal. The the range, very, very small numbers. So they're continuing to bring these numbers down below, to slightly below the 1% mark on the ATR. As in 1% would be 3.5, and we're at 3.38. And again, like I said, the other thing too to watch, for any kind of move to the downside to begin, for this gap to make its way back up, for one of these to get back to where the other one is, you're going to have to get a pretty, at least a 1 standard deviation gap to the downside, more than likely, and if not, at least a couple percentage point drop here. That will shake things up. And so that, obviously that won't happen out of the blue. So you need a catalyst for that to happen. So we're not going to get the beginnings of this until there's a catalyst that says, okay, now we're not so bullish anymore. Because right now, all the bulls that you have that are currently strongly bullish in a lot of these areas are very, very weak hands. So, and that's where you can get a 20% drop in the NASDAQ on a move simply down to 38% retracement, and not change the trend. Not because of, again, just how bullish we've been and how many people have been kind of piling in here late trying to catch that freight train, so to speak. All right, then finally, let's take a look at volatility here, which is another interesting because it's been so bullish all week long, but look how we finished. So we finished low, even though we're at 22.68, which is, a pretty decently high level compared to where we've been for the last few weeks. But on a relative basis, it's the lowest we've been. Like, we close at the lowest possible level for volatility that we have in a very, very long time. I mean, to get down to a close of 77%, I mean, that is sharply lower. Like, we have to go back pretty far to see, especially a weekly close. Weekly close down to such low levels. I mean, this one we were at 77% on the week, but it wasn't, if you notice on the daily chart, not quite the same. Very, very significant low point, and you can also see that actually too on the intraday. In fact, here, let's go back to the intraday chart. And again, you can see the same thing. Like, we were pretty close down here, but not nearly. I mean, look at that. That's a little blow off topish, at least blow off bottomish on volatility. It's extremely, extremely low. We had a little bit of a pop here, but now we don't really have a whole lot of room for it to go down. Like, it's going to be hard for the VIX to go down further, and especially get below 20 when it's already so low on a relative basis. And the reason being is because as much as we've dropped on the VIX, we didn't drop as much on VIX 3M, which is actually higher than any of these levels. And it's, that's why this is down so much as it is. So volatility is still setting itself up for, a significant move. A lot of people have been kind of talking about the 50-day or some moving averages in the VIX, and again, there's the break, there's the bandwidth that we've been in, and more often than not, volatility will stay in the lower half of the band. There was a little bit of a pop up to the upper quartile of the bandwidth, but the bandwidth is so low. It's even lower than where we were back over here. Like, it's like down to this level low point in November of 19, and that's when we started to get some inklings, right? Some tremors before the big earthquake occurred. So we'll see if this starts some tremors again ahead of, again, a volatile period of time in September, October. All right, so to summarize this technical outlook, obviously we're still very bullish. In fact, we're getting to some extremes. Not as extreme as, the most recent example of January 2018, but pretty darn close. And pretty, if it wasn't for January 18, this would be considered extreme. And we still have a couple weeks left before we hit, that kind of mid-September where we hit the 5th month of the intermediate trend. And again, we just know how those end. And until we see the spark, until we see a catalyst, until we break the 8-day moving average and the S&P and the VIX breaks, and these different things happen that I've talked about before, a larger gap to the downside, which is usually what happens because we see so many bigger moves occurring overnight lately in the extended hours trading. So until we see that, you just kind of grind higher here, riding the trend, reducing exposure, especially to this overbought tech sector, this QQQ sector, having some still because it's still rising. We don't know how long it's going to rise, but reducing it, taking advantage of these moves to reduce exposure, so that if and when that January of 18 type pullback or early February type pullback comes, which was purely, like retracement levels. Like, again, 20% drop on the NASDAQ right now would not be that big of a deal. Obviously, it would be because you'll have a lot of people going crazy, especially the stocks only go up crowd. crazy. And the media will be saying 20% drop. The Nasdaq's in bear market. It's not in a bear market. You know, and when you have a 70 some odd percent run, a 20% retracement is nothing. When you have a 20% run, a 20% retracement is something. When you have a 5% run, a 20% retracement is something. But not a 70% run, which is essentially what we are on right now. So if, you know, when that does happen, it's going to freak out a lot of people, but it's not going to be anything more than just a retracement. And that won't start until there's a catalyst. And now we can take advantage of these strong moves, not to eliminate exposure to the Nasdaq 100, but reduce. And again, last time I really kind of talked about that in that kind of manner was January 2018. So take advantage of these moves, stay bullish, ride the trend. You can even have we have some tech spot names in our class portfolios, but not nearly as much as what I had a few months ago, because we've been gradually reducing our exposure as we continue to show extreme bullish signs. So what do you think? Do you agree with that technical assessment? Do you disagree? Comment down below either way, especially if you disagree though. Let me know what you're seeing that suggests why you're either a lot more bullish than I am, and then the markets apparently are, or why you're a lot more bearish than I am, that you might expect, you know, a much bigger decline than just a 20% retracement. All right, now I wanted to talk about what's driving this price action. So let's just look at this week alone, right? This week alone here, and see how things move. We'll go to a 15-minute chart. And, you know, there's your Nasdaq 100, just really killing the IWM by more than double. So a big kind of blow off top move in that relative strength of Qs to IWM, as I've shown you that chart before. S&P obviously strong, because that's pretty much what the S&P is now, is the Nasdaq 100. You can see emerging markets did very well. They didn't outpace U.S. stocks, but they certainly outpaced the broader Russell 2000. You can also see commodities doing well. Gold up with the dollar is down. The dollar really down today. So if I go back to, let's look at this chart here. If I take a look at the Euro US dollar, look at that big pop. Now again, I'm not like we didn't even get the near term. That's on a weekly chart, mind you. Here, let's go to a daily chart. You can see like we still haven't really even finished this intermediate run. All this has been is light pink shade. Didn't even get a yellow line. So, and this run started a little bit after obviously the stock market rally started, which started back mid-April is when the intermediate run started on stocks. And we're looking at kind of the end of May. But still, you know, we're 3 months into this run, very, very mature run. I don't expect too much of a bullish move here, just kind of some choppiness as we kind of top before it leads to some kind of retracement level itself. You can see it's kind of flirting, if I were to zoom out a little bit more, with that 62% retracement of this decline that we had in the dollar coming off of those early 2018 highs, where again that bear market, why I said that bear market started, and the dollar, you know, rising dollar was a big function of that. Well, you know, now we're right about the 62% retracement level of that particular drop. So we're kind of flirting with this area. I don't think we'll really take off without some kind of move back, even towards like the midpoint here of this retracement zone before we really get going. But I do expect eventually that we will break through the 78. We'll get back up to this 100%, if not break through that, because I believe that we're in a mode for a long-term decline on the dollar, and for that matter, the beginnings of a rise in the yield. How about this? The yield's finally getting an overbought cluster. The yields haven't gotten an overbought cluster in a very, very long time. Like, you know, if I can't, let's see here. Let's do auto and let's fit the studies. There we go. So there's our last cluster that we got on the yields. Right before this whole mess started in the fall, November 2018, and it started its decline. This is the first one in a long time. So that's actually a very good sign that this new bullish run, intermediate run that we're on, can really get going to the upside. That's going to play a lot into our trade idea here in just a minute. All right, let's take a look at the sectors. and how they perform this week, and it's not going to be that big of a surprise to anybody. Let's take a look at the 15-minute chart here. All right, and you can see, look at tech and communication services. The one big surprise for the week is the financial sector. Those rising yields really benefit this really beaten up sector. On the other hand, the rising yields hurt the utility sector, and you can see why it's significantly down to the downside, and other safe havens as well. Industrials, materials, energy ramping up here with the weaker dollar, materials as well. A lot of these sectors are very low, like industrials and financials especially, but industrials, energy and materials, they're all way below relative to the S&P. Their 2008, 2009 lows. Again, relative to the S&P, so not an absolute basis, because actually financial is a lot higher on an absolute basis. But on relative to the S&P 500, because of these tech names, they've really outperformed, underperformed. To kind of give you an idea. This doesn't show you relative strength, but it does show you a comparison of how things have performed since the beginning of 2009. And let's just go to a weekly chart here, up until now. And again, there's like energy is actually below. It is below on an absolute basis, but there is XLF, and then there's SPY at 377%. So XLF really struggling, especially when you look at the after the credit downgrade, really struggling there. And then look at the returns in XLK and XLY, just insane returns. And you would probably include XLC up here too. They just didn't exist in 2009. Neither did real estate ETF. But you can see the kind of moves in just cyclical areas really lagging the S&P 500 during that time frame from that particular low point. So they're still below those 2009 lows on a relative basis. Same with materials, and very much so with energy and utilities as well, and consumer staples. You would expect that out of the safe haven areas because of how bullish we've been. I wouldn't expect it out of some of these more cyclical areas, especially financials and industrials. So for our trade idea of the day, I did want to take a look at financial that I think will benefit from that overbought cluster on yields, and that is Charles Schwab. Now, Charles Schwab also has an interesting development coming up because its merger with TD Ameritrade should be complete here by the end of the month. It's only a few days away, another trading day away. So it's got some really good opportunities to take advantage of rising yields better than it did before the merger. And you can see when the merger was announced back here in November 2019, it's then we had the COVID low point, and it's just been kind of a struggle ever since for the company. It's been kind of flat and very noisy, but we're starting to see some signs of a new trend developing, right? Getting above the 50-day moving average with the rising PPO down there. You can see the stochastics getting into the reversal zone. Absent that kind of catch-up trade that we had in June, this is obviously not nearly. This is a lot more able to sustain itself than that type of move, which is pretty short-term parabolic. The MACD is rising, as well as you look at the RSI for Charles Schwab getting up above 60. Again, the only other time was in the last year or so has been that parabolic move. And then the DMI, same thing on the DMI. You can see how that ADX is really rising now with a negative index way below 20, and the positive flirting up with a 30 level. And you can see getting into the Ichimoku cloud, and getting above 38 will be very significant. And you can see from a Bollinger Band perspective too, we're getting above the 1-year point of control, and again that 38 level right in this area, getting above that is very little path of resistance, path of least resistance until you get up to this 48.50. So because of that, I thought, in this particular case, I want to be a little bit more longer term in Charles Schwab. So what I'm going to do is I'm going to look at buying this call option with a 50% stop order, buying that call option out to December. So it'll give me some time just in case there is some volatility in the broader markets as a whole. But if these clusters at the beginning of these intermediate runs in the 10-year yield and these financial stocks plays themselves out, and then Schwab gets the other boost of being done with this kind of merger it's been, that was pretty bullish for it previously, as you saw before, the COVID crisis kind of hit the stock, and it was unable to really get going since. So, if it's able to now get back to the bullishness that it had, you had some pretty good, it was all the way up to, right around the 50s area when that merger was announced. So it's got some pretty decent room to run, and we'll give it some time for it to do that type of move if it were to play itself out. All right, so that does it for today. As you've heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You can open up any new thread or reply to anybody else's thread, and let's keep this conversation going. As always, thank you for watching. Subscribe to our YouTube channel. Hit that thumbs up icon on YouTube, as well as on Twitter and Facebook too, on those posts. And then comment on our video. Follow me on Twitter for more content between the videos. Make sure you're following me there at DavidSettle42, and then join our website at marketscholars.com for free, as well as our Facebook group that we have. As always, thank you very much for watching. Have a great rest of your weekend, everybody, and we'll see you all on Monday.